Lucid continues to be one of the more highly valued automakers in the US. As I'm recording after the market closed on Wednesday, shares are trading at about an $8.3 billion valuation. But is that an opportunity for investors in the disruption that's potentially happening from the electric vehicle market? Or should we be a little bit more cautious, hold or sell the stock? That's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I'm going to just show a lot of operating trends for Lucid in this video because I think this really shows where the market is going. And the first thing is going to be the number of vehicles produced and delivered. Production is the black line, deliveries is the blue line, and this is on a trailing 12-month basis. So you can see that Lucid is only delivering about 9,000 vehicles per year right now. Yes, that is projected to increase, but that is an extremely low number. And the thing that you have to keep in mind with an automaker is if you're only producing 8, 9, 10,000 vehicles, you really have no idea where your supply demand break points are. And I think that's something we really need to think about with companies like Lucid, with Rivian. Yes, they all have plans to increase their production, but if you have a price point of $60,000, $70,000, $80,000 per vehicle, there's a point where you can't sell 250,000 $80,000 vehicles. There's just not enough demand for that, whether you're talking about the US or around the world. Even a company like Ferrari, who's been very successful selling very high-end, very expensive vehicles, tries to underproduce. Basically, they want that supply to be lower than the demand for their vehicles. Lucid is trying to answer the question by increasing their own production. One of the things that they're going to be doing is moving into a mid-size platform starting in late 2026. But guess what? That's 2 years from now. Until then, the company is selling vehicles that are at a very, very high price point at a time when the market is moving down towards lower cost vehicles and smaller vehicles. That's where you see growth from traditional automakers. And it's where you're seeing manufacturers like Rivian and Tesla introduce new products. These EV companies that we're talking about today, they're trying to increase their supply. And the reason that they need to increase their supply is their current economics are absolutely terrible. This is the gross margin and operating margin for Lucid. You can see gross margin is the black line, negative 132%. That means that for every dollar in sales, they lose $1.32. That's just the gross cost. So that's basically the cost to operate a manufacturing plant, to buy equipment, to buy raw materials, to pay workers, all the kind of stuff you have to make a profit on. If you are not gross margin positive in any business, you're not going to be able to survive long term. And then you go to operating margins and you're looking at negative 411% over the past year. That's just absolutely terrible results. And that's what's ultimately going to get you to this chart, which shows the cash from operations in black, and in blue is free cash flow. So operations are burning about $2 billion per year right now. And free cash flow, when you add in capital expenditures, negative $2.8 billion. So that's the current state of Lucid. Not generating a positive margin, not generating a positive cash flow, and the numbers are staggeringly large. I think the fundamental question is, how do you scale this business, and do you have enough demand if you can scale the business? And I think that fundamentally the answer to those things, as we see them today, are no. There's just no opportunity to get the current business to cash flow positive, especially when you look at the balance sheet. Here you can see the company's cash in black, $3.5 billion worth of cash as of September 2024, but there is $2 billion worth of debt. So not a lot of net cash on the balance sheet. How do you stay in business when you're burning through that much cash? You issue shares. That's what this orange line is. 1.7 billion shares outstanding at the end of 2022. Right now, that is 2.3 billion shares outstanding, and could increase a tremendous amount given the fact that shares are trading for just $2.53 per share as I'm recording today. If they need to raise another billion or $2 billion, they're going to have to dilute shareholders even further and dilute in really, really large numbers. This is, again, the fundamental problem with Lucid. Yes, investors think that Saudi Arabia is going to save the company. I just don't see that working out well for investors. They're going to do that by wiping out equity investors because they also hold debt. So they basically control the debt piece of the company's capital structure. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. As it stands with Lucid today, this is just not a sustainable company. And I think this is what investors are going to have to figure out. with the auto business, on top of all of the Lucid specific things that I talked about earlier, their negative margins, their negative cash flow, their problems with their balance sheet. We also potentially have a lot of headwinds going into 2025. It's very possible that the $7,500 tax credit is going to go away. It's very possible that some of the subsidies to battery makers, to EV manufacturers, that those are going to go away in 2025. The regulatory credits that companies are getting from states like California, that may go away. So a lot of the tailwinds that have been taking place over the past few years for the EV industry may be eliminated and may end up becoming headwinds. At the same time, you have a lot of economic questions. One of the things that automakers are always facing is macroeconomic pressures. When you go through a recession, if your demand drops 30, 40%, that means that you are selling 30 or 40% fewer vehicles. You're likely doing that at a lower price and a lower margin. If your margins are negative to start with, how are you going to make more money? How are you going to ramp up production and increase the supply of EVs in the market when there's not an increase in a commensurate increase anyways in demand for those electric vehicles? So you add all of these things together, and I think Lucid is just in a really tough position. There's no easy way for them to get out of this financially unless they're bailed out by their Saudi Arabian investors. That's maybe the best option for them. They could potentially sell to another automaker, but you do have a couple $1 billion worth of debt on the balance sheet. Most of those automakers are not going to want to take on a new manufacturing challenge. So like Rivian, I think there's just a lot of challenges for Lucid. I don't see a bright future for this company. It doesn't mean that their vehicles aren't really impressive. They have a lot of really impressive technology in that, but that does not make this a viable business. And as a result, I think this is a stock that investors should be selling for what they can right now. Because with a valuation of over $8 billion, I can't imagine how they're going to generate that kind of value in the auto business long term. There's just too much competition in the auto business, especially in electric vehicles today. Doesn't mean the stock can't move higher short term on speculation. We've seen that with a bunch of electric vehicle makers in the past, but the really optimistic view of Lucid that I think the market has had a couple of years ago is kind of out the window because their operations just haven't lived up to that speculation. But that's where we sit today. Hopefully that's helpful in understanding Lucid's position in the market and their financials. What do you think? Are they going to be able to turn around those margins, in particular in their free cash flow? Leave your thoughts and comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.